We're back with tax tips number 8 out of 10. Common question I get from my law firm partners is if it's worth taking a loan versus paying something upfront. Let's say you want to buy a car, you're buying equipment, furniture, research material, whatever it is. Should they take a loan for it or should they buy it upfront? And the question has come from tax perspective, obviously, and from tax perspective, it doesn't matter. You get the deduction when you actually purchase the equipment or the book or whatever you're purchasing, and not when you pay for it. So if you take a loan and pay, let's say 20% upfront and the remaining over 5 years, you get to deduct the purchase the year you actually purchased it and not when you pay it over 5 years. So the tax benefit is pretty much the same, but you got to consider what you could do with the money other than paying it for the purchase. Maybe you can invest it and make more money than you're paying the interest on it. Some people can invest very aggressively and say 15, 20, 25% on their money. Other people think, you know what, I'm going to put it in a bank and make 1 or 2% on it, but I'm going to pay the other bank when I'm purchasing it from 5, 6, 7, 8, 10% interest. It doesn't make sense. So you got to look at the economics. It's not always the tax consequences. A lot of times we got to dig into it, look at it from the economic perspective to be able to advise and help you for your tax perspective also. And make sure you really look at the details before you make a decision on whether you should pay something upfront or take a loan for it. I'll be back with tax tips number 9.